Hi, I'm Tom Lydon, editor of ETF Trends here in Newport Beach, California at the PIMCO headquarters with Jerome Schneider, Managing Director, Head of Short-Term Fixed Income Strategies at PIMCO. Great to see you, Jerome.
Thank you very much, Tom.
I also want to congratulate you again for being selected Morningstar's Fixed Income Manager of the Year. That's a great, great honor.
Yeah, the team's very proud of it. We're very honored to have the award on behalf of the PIMCO Short-Term Fund, and it's obviously one tool in our franchise that we hope to bring to clients, and hopefully we'll talk about a few others of those today.
We want to talk about two important ETFs offered by PIMCO, both short-term oriented, Mint and LDUR, Elder. So tell us a little bit about them, and most importantly, what are the differences? Because they seem quite similar in nature.
They are similar, but to get an idea of why we're produce these two ETFs for our clients, you have to understand that for ourselves in the short-term business, we want to offer clients access to the entire short end of the curve, and recognizing that there's very large differences even though the front end of the yield curve is a very small place. And so in doing so, we manage $200 billion worth of strategies within that front end space, everything from money market funds to low duration strategies. Mint, our enhanced short-term strategy, is meant to simply to be an incremental step outside of money market funds. Preserve capital, a little bit of income, focus on US dollar denominated securities, and do so while all being the largest actively managed ETF out there. So we're very proud of it. It's been in existence almost 6 years now.
And the key that you mentioned is actively managed. Most people think about index strategies when you think about ETFs, but by having it active, you have the ability to be nimble. At any day, if you see a shift that goes on, you can take advantage of it, or you can get out of a position without having to wait for a rebalancing within an index, correct?
Right. It becomes incredibly important in this environment where we have economic policies which are divergent, potential for increasing rates here in the US and decreasing rates elsewhere. But more importantly, from a capital preservation point of view, allows us to be defensive when we need to be and offensive when we need to be. And this is most specifically articulated in our other ETF strategy, Elder, LDUR, which is our low duration strategy, which looks globally for these opportunities. It doesn't take a lot of interest rate exposure. It still is at the front end of the yield curve, but it really focuses on opportunities globally while looking at a relatively low volatility footprint, meaning it's again focused on capital preservation, but its holding period is a little bit longer. So the key message is, in past episodes, money market funds have been an apathetic afterthought. And now your cash allocation needs to be an active allocation. And we would encourage advisors to tier those strategies.
Great, great ideas. As always, Jerome, really enjoy getting time with you.
Thank you very much.